So for all you more aggressive investors out there who still feel like they're in the strong growth phase of their portfolio building, then this video is for you. Now, in general, if investors are chasing a higher rate of return, then what are they supposed to do? The stock market only returns about 10% a year long term. Even if you put all your money there, which is very ill-advised in my opinion, but with real-world inflation around 5%, you're still not doing that well. And you'd have to suffer through multiple 50% drawdowns that can last for many years. I would also imagine another market crash is coming at some point down the road. Now, adding a bond allocation does reduce the risk a little bit, but now the return is likely only around 8% long term. That's just not going to cut it if you want to grow your capital. Now, I've solved this problem utilizing what I call tactical rotation through volatility targeting. Essentially, I'm data mining volatility metrics to tell me when to hold those aggressive market positions, when to protect my capital and move to safety, and when to flip that switch and actually try to capitalize on a market crash. You can check out this video after for a perfect example of what I mean here. But with just 2 to 3 trades per month per strategy, I've returned about 20% a year since I officially launched VTS in January 2012, and we've done it with very manageable drawdowns. Now, within my total portfolio solution, I've always made sure there's a balance of aggressive and conservative strategies, both correlated to stocks and inversely correlated to stocks, working together to smooth out performance. Overall, there's been great periods, there's been stretches of mediocre, but long-term, this is the risk-reward balance that I'm targeting. However, not all investors have the same risk tolerance that I do. Some of you who follow my work have said that you feel I'm just too conservative. You may still appreciate the tactical nature of my strategies, and believe me, I'll never stop prioritizing risk management above everything else. But you might be looking to chase a little bit higher rate of return, which is fine if that's what you've chosen. The solution for you is actually very simple. Instead of trading the full total portfolio solution with all 4 strategies at 25% allocations each, you can just skip the conservative strategies and follow the absolute return portfolio instead. That's 50% allocations to our top 2 performing strategies, tactical volatility and defensive rotation. Now, I'll highlight the performance differences between those 2 portfolios in a second here, but I do want to stress that both of those strategies do have the full risk management still in place. Tactical volatility is a short volatility strategy that during stable market periods will be holding the inverse volatility ETF called SVXY. When volatility is elevated though and market risk is rising, the strategy shifts into the safety position of GLD gold. And then during the most extreme volatility readings, this strategy can capitalize on market crashes by going long volatility through the VXY. And the defensive rotation strategy has its own set of volatility metrics that when signaling stable markets will be holding the 2 times NASDAQ ETF called QLD. When volatility rises and it's too risky to be holding stocks, we shift into the safety position of XLU utilities, which do perform much better than stocks during ambiguous market periods. And then in a crisis, the strategy shifts entirely to cash and we just wait it out safely on the sidelines. So even though both strategies are similar in their tactical nature, they use different volatility metrics to get the trade signals, different asset classes are held in each of those ranges, and the thresholds themselves are also at different levels. 3-point diversification, which means these 2 strategies do pair well with each other. Now, like I said, these are the 2 most aggressive strategies that we have, which does mean that both of these broad portfolios will have different risk-reward ratios. As we can see when comparing them side by side, the first thing that will stand out to people is the rate of return. This is what many investors are chasing, and our 2 most aggressive strategies have returned over 30% a year since inception. But always remember that risk does cut both ways, and the higher return does come at a cost. The average of the 3 largest drawdowns is also higher at 24% versus just 16% for the fully diversified portfolio. When we view that ratio through the risk-adjusted return metric that I designed called the VTS Performance Score, I've got a link for that video here you can watch later, but we can see that both of these portfolios are about the same, give or take. Just because one of them has a higher rate of return doesn't mean that it's better. On a risk-adjusted basis, they are about the same. When comparing to a 60% stocks, 40% bonds balanced index fund though, which most investors are tracking something very similar to that, then the difference is clear, especially in the risk-adjusted metric. Naturally, a portfolio that returns high double digits is going to have some drawdowns, but the risk-adjusted metric, the higher the value the better, tells us whether the return is worth that higher risk. And in this case, clearly yes. These two strategies, focusing on short volatility and the NASDAQ index, both with mechanisms to move to full safety when necessary, have served me well for many years, and it's definitely worth your consideration. Some investors can sustain a 35% drawdown and still stay the course, but others just can't. It's not for me to tell you what your risk tolerance should be. Like I said, if you are in that strong growth phase of your investing journey, then perhaps for you it is worth taking on a little more risk and following that absolute return portfolio. For those of you that are on more cruise control at this point, and full disclosure, that is me, I always trade the fully diversified portfolio with all 4 strategies. But if you're like me, then the total portfolio solution is the perfect balance. Technically speaking, both portfolios are about equal from a risk-reward perspective. You just have to match up to your own risk tolerance. Now, as far as the daily email goes, everything in there is showing signals for the full total portfolio solution. 25% allocations to all 4 strategies. If you've personally decided to only trade the absolute return portfolio, then it's very easy. You just allocate 50% to tactical volatility and 50% to defensive rotation. That'll give you about 2 to 4 trades per month per strategy, which means you can follow this in just a couple of minutes a day. Traditional investors will feel every bit of every single drawdown that the market has. But tactical investors, with just a few strategic exits to safety, we can get the benefits of a bull market while still protecting capital when it matters the most. This is how I've been steadily growing my investment account, and you're always welcome to claim your free trial on my website or down in the description below and join us anytime. So now you can check out this video, which goes over all 4 strategies in the total portfolio solution. From there, you can weigh which one best suits your own level of risk tolerance. I'm more the conservative type, but if you are a little bit more aggressive, that's totally fine. And the absolute return portfolio is going to be perfect for you. See you next time.